Has the Federal Reserve revealed a problem with hedge funds? In this video, I discuss a potential idea that the Federal Reserve is tossing around that would actually end up lending money directly to hedge funds. So, in the news lately, Federal Reserve officials have been considering a new tool that would ease the stresses in the market for Treasury repurchase agreements, or repos. One solution that's been bounced around by the bank is lending cash directly to smaller banks, securities dealers, and hedge funds. Now, all of this would be done through the repo market's clearinghouse, the Fixed Income Clearing Corporation, or the FICC. Currently, hedge funds borrow through a process that's called sponsored repo. In sponsored repo, a large bank acts as a middleman, and they pair government bonds, which are held by hedge funds, for example, with money market funds that are willing to lend cash. In this little graphic from BNY Mellon, it talks a little bit about what a sponsored repo transaction is. In a sponsored cleared repo transaction, BNY Mellon sponsors your trade into the FICC. This means that after initially trading into a bilateral repo trade with BNY Mellon, we novate that trade into the clearinghouse, resulting in you facing FICC directly, but without the responsibilities and obligations of full CCP membership. Now, the Federal Reserve is looking to step back their repo operations. Their goal is to step back from temporary efforts, repo operations, and not quantitative easing, to calm repo market volatility and increase financial reserves. After all, the Federal Reserve's balance sheet has grown from $3.7 trillion in September of 2019 to almost $4.3 trillion in mid-December or mid-January 2020. Part of the problem is that the liquidity rests in only a few hands. The Fed trades with primary dealers or a small group of large banks and securities firms. According to a study from the Bank for International Settlements, the liquidity in the repo market rests in the hands of the four largest banks in the U.S. system. This includes JP Morgan, Bank of America, Citigroup, and Wells Fargo. And there's a problem of access. The idea of using a clearinghouse appeals to some analysts and investors because the Fed has had trouble getting cash into the hands of smaller banks, security dealers, and investors who may need it the most, so they say. Critics of the new plan have said if the Fed lends cash directly through the clearinghouse, it could look like a hedge fund bailout. And the problem centers on the central bank lending directly to hedge funds, which are little regulated investment vehicles and generally serve the wealthy or institutional investors. And are they adding fuel to the fire? The political backlash that followed crisis-era bank rescues hangs over policymakers' approach to the current problem. We're all reminded of 2008 and the big bailouts, Occupy Wall Street movement. Some fear that lending directly to hedge funds could lead to the perception that the Fed is fueling risky bets. And the reason for that is because of leverage. The hedge funds use significant leverage. As you seen in the other video I put out there, if you haven't watched it yet, go check it out. The biggest hedge funds, Citadel, Millennium, Point42, they use multiples of leverage to help increase their returns. Regulators should be reluctant. Hedge funds use borrowed money to increase potential gains from investment, but that strategy will magnify losses when things go south. And regulators should be reluctant to provide a tool that would allow the overall leverage to increase beyond current levels. Leverage is a tool, but at high levels, it becomes simply unsustainable. So what do you think? Should the Federal Reserve lend cash directly to smaller banks, security dealers, and hedge funds through the FICC? Share your thoughts in the comments below. Did you enjoy this video? Please give it a like and subscribe to my channel for more in the future. Until next time.